Good morning from snowy, overcast Chicago, where people are simultaneously digging themselves out of a huge snowstorm that we had on Saturday and also celebrating the Chicago Bears' 9-3 record and their position at the top of the NFC Central, which hasn't happened in a long time. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, November 30th, 2025. In today's podcast, our focus is on the benchmark S&P 500, which was saved from a much deeper decline last week due to a successful test of an underlying support level that we've been identifying and talking about to our subscribers for the last week or two. That bounce that we had off of support was further supported by some dovish Fed speak that we had a little later in the week. Our question right now is, how sustainable is the rally we had last week? We're going to talk about that in just a few minutes. Before we get started, I want to let you know that we're currently offering a Black Friday sale that's going to run through tomorrow, December the 1st at midnight. So you got about another day left, day and a half. We're currently offering 25% off of our 3 and 12 month premium research subscriptions, which is the biggest discount that we've ever offered since we opened in 2005 for Asbury Premium, and brings our annual and quarterly subscription rates down from $1,800 and $499 respectively down to $1,349 for the 12-month and $374 for the 3-month. Our Asbury Premium is meant for more serious investors and includes the latest updates on everything we do, all of our models, all of our strategies, and also give some personal one-on-one instruction to you via Zoom when you first get started, so you can hit the ground running and start to implement our models and strategies in your portfolio from day one. We're also offering a 60% off sale. Again, this is through the end of the day tomorrow, December the 1st, off of our entry-level Substack subscription, which drops an annual subscription from $250 to only $100. This subscription does not include all of the trading models, but offers selected reports and model updates from our premium research products that are offered on the Asbury Premium. You get at least 3 updates a week. If you're interested in either of these, your time's running out. Go to asburyresearch.com, which is where I am right now. Use the contact tab, which is right here. Tell us which of these 2 services you're interested in, and we'll get an email out to you, and you'll be able to sign up online. Again, all these offers end at midnight tomorrow, December the 1st. All right, let's get started on looking at some markets, which is why we're here. The first thing I want to do is take a look at the Asbury 6. So we're going to go inside the paywall, which is a research center, and we're going to look at the A6. A little background on the A6. The Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected via quantitative backtesting. Every individual indicator has an Achilles heel. Nothing works all the time. So what we did is we backtested all of the tactical indicators that I've used throughout my 40-year career, the ones that I had success with, and we started to backtest them in various groups, groups of 3, groups of 5, to try to find something that would keep us on the right side of the market most of the time, and we came up with 6 indicators. It has an advantage over using 1 or 2 indicators, again, because you're getting a lot broader look at the market. So we use the rate of change, we use relative performance, investor asset flows, volatility, trading volume, and market breadth. Think of it as kind of an EKG for the stock market. It's updated about 2 hours after the close every day, and it tells us the real internal health of the market, and not the what's kind of become the norm, where the S&P has these volatile days where it's up 50 in the morning and down 50 at night. This helps us to get shaken out of good ideas by kind of looking under the hood of the market. So right now we're 5 of 6 green, 4 or more green. It indicates a positive market internals. 4 or more red indicates the market's weakening and it's vulnerable to having a decline. As long as the A6 remains 4 or more green to retain the positive signal here, it's going to tell us that the rally we had last week is sustainable and we can go up and challenge that 7,000 level that everyone seems to be talking about because it's a big psychological level. Next thing we're going to do is we're going to go back to the research center and we're going to look at one of the reports that we do every week. It's called the weekly wrap-up. As the name suggests, it's at the end of the week. This one was just actually produced a few hours ago. We don't normally show something this new on our free YouTube, but I'm going to do it this time just to give you an idea, real time, of what we look at, especially since we're running the sale here through Monday. So the weekly wrap up, there's 3 things I wanted to show you. The first one was we talked about this support level. The support level is at 65.69 to 65.51. It's based on the lows that were made on September 17th and October the 10th. So it's been there a while. It's not something we just found 3 days ago. It's a big level. It was tested and started to break down through about a week ago. And then early last week, it started to hold. And then again, we had some Fed speak that was also advantageous to the market. And here we are again, up around 68.50. Key levels to watch next week. 67.25 is the 50-day moving average. It's a minor support level. But again, 65.69 to 65.51 is the big level that we really need to hold. A couple of other things that we're looking at closely and that you should be too. Number one is volume. This is cumulative volume. There's raw and cumulative. Cumulative is the one that we typically like to follow. It's a little smoother. And what happened at the end of last week is it started to expand above its 21-day moving average. Why the 21? Because that's Asbury Research's tactical time period. So as of November the 25th, we got back up above the 21-day moving average, which means you're getting that healthy urgency to buy that a market needs to go higher. The other odd thing about this chart I wanted to point out is look at how it's bounced back and forth above and below the 21-day moving average 6 times. That indicates that all of this is uncertain. All this whole topping period, or whatever you want to call this, basically from the second week of October, the market's not sure what to do with this. They don't know if this is a buy or if this is a sell. So you're getting all these changes of opinion here. So it's really important for us to see volume stay strong next week. The third thing is volatility. Volatility shows fear. This is kind of a derivative of the VIX. It's the iPath Series B S&P 500 VIX short-term futures ETN. VXX is the ticker, and this is a little bit smoother than the VIX, and we like to use this. So note that it dropped below its 21-day moving average again. Latter part of the week last week meant the market was kind of breathing a sigh of relief. It helped the rally that we had on Friday. But also look at the bouncing back and forth since second week of October, that same time period, all of the sideways, these crazy moves up and down. These are 6% moves up and down, but this just shows you that the market's not comfortable here. So it seems like everything is hunky-dory after the end of last week, but it's really not. The market is still nervous, and you can see that in these 2 indicators. The next thing we're going to do is look at sector rotation via our CEF model. Our CEF model, let's get to the graphic. CEF is currently overweight XLV, XLK, and XLI. XLV, healthcare, it's been overweight now, 6-7 weeks. it's outperformed the S&P 500 10-11% during that period. So what this does is this basically measures the velocity of assets that are moving in or out of the 11 sector spiders, which if you put them together, it's the S&P 500 in 3 different time frames. So right now, healthcare is up at the top. It's number 2 in trading. It's number 1 in tactical and number 1 in strategic. So this is kind of where we're looking at. The CEF model is always fully invested in the market, and it's meant to replace that buy and hold portion of your portfolio that always stays in the market, no matter if the market is up, down, or sideways. This is done dynamically, and we're following the parts of the market that have better asset inflows than the other sectors. So it's kind of a scientific way to use buy and hold, being in the parts of the market that everybody wants to go to and avoiding those where the money's coming out of. Since inception in mid-2018, CEF has significantly outperformed the S&P 500 on an annualized basis with better risk-adjusted numbers, meaning better standard deviation, lower standard deviation, should say a lower beta, and a smaller maximum drawdown. So it's very hard to have both. It's kind of having your cake and eating it too. The CEF has done this over the past 7 years looking backward. The next thing we're going to do is we're going to look at another aspect of our service, which is our ETF trade ideas. These are meant to be trades rather than investments. The average time in a winning trade is 18 business days, just under a business month. The average time in a losing trade is about 8 business days. 54% of these make money, and our average winning trade is 5.4%. Average losing trade is only 2.4%. So these are the ingredients that you need for a repeatable, successful way to trade individual assets over time. This is looking backward 30 months. So right now, we've got gold miners. We had actually been long gold miners. If you look down here, we were long gold miners from September the 11th to October the 21st. And actually, that was August the 6th to October the 21st. We outperformed the S&P by 31%, and outright, RANG, that's the symbol, it also rose by 31%. So now we're back in there as of last week. We're also in the dollar. We're also in soybeans. There's an ETF for soybeans now. And biotech is the one we've been in the longest. IBB, we bought that on October the 16th. Let's just jump over there and have a look at it. So here's where we bought IBB right here. This is outright. This is relative to SPY. So here's our appreciation here. 13% here, and we've outperformed the S&P by about 9, if my memory is correct. Yep, 9.12. Something to look for if you're in IBB. We're coming into this really important resistance level. This is the all-time high here, going back. I don't know if it's all-time. It is all-time. It's all-time high going all the way back to the first part of the century here. That level is at, let's call it 170. So if we can break through 170, we're going to hang on IBB. We got a nice lead there in just a relatively short period of time. If it doesn't hold, we'll be very fast to ring the cash register and look for the next idea. The Asbury 6, let's get back to where we were before. The Asbury 6, the CPM, and the CEF model, all of our ETF trade ideas are a part of Asbury Research's premium research service. Contact us via the contact tab at asburyresearch.com to request information about any of these services and details and pricing. Finally, let's take a quick look. I told you we'd look at our Substack entry-level subscription, and here it is. 2 things. Chart Focus is once a week. Here's our most recent Chart Focus, and this is a detailed look at the market looks at global markets, it looks at global equities, it looks at relative performance, and it gives you 10 key charts that we think are the most important to look at. It'll be support and resistance. It'll be at relative performance. This is the MAG 7 versus SPY. This is another relative performance, XLY versus XLP. It looks at investor sentiment, and it looks at size and style, which is small, medium, or large, or if you want to be in growth or value. And then the next thing is our sort report. So let's just take one step back here. The sort report is twice a week, and this is a model. This is a quantitative model that looks at a broad array of different assets to invest in. The dollar, gold, interest rates, small cap, commodities, global equities minus the US, emerging markets, technology, oil, crypto, everything's in here. And then we look at it through the lens of trend, relative performance, and money flows. And the ones that are green all the way across means it's clicking on all of those three different criteria. This is a way to find out where the opportunities are, looking at a large group and making it small. So you can pick out the ones that are sort of have the bones to do better. They have the initial structure to go higher. So there you go. That wraps up our latest Asbury Research Following the Money podcast. Don't forget about the Black Friday offer. One more day. Our next Follow the Money podcast is tentatively scheduled 2 weeks from today, Sunday, December the 14th. I hope to see you then. In the meantime, again, any questions or want any more info on any of the stuff we do, we also have managed accounts here for different model portfolios. Please contact us right here, asburyresearch.com, and go to the contact tab. Hope you had a lovely Thanksgiving. I will see you again in 2 weeks. Don't forget to like and subscribe.